Welcome back to another episode of the Investor Professor Podcast. This is Dr. Ryan Peckham, and this is episode 48. In this week's episode, of course, I'm going to talk about what happened in the market this past week, but the majority of the time will be spent on Warren Buffett's 1963 investment into American Express. And I'm going to take you back to American Express in 1963, the scandal that they were facing, and maybe why Warren decided to make this one of his top investments at the time, looking at the company, the structure, all of those things, so that we can use that example to help us find companies today that look the same way. So I hope you'll get your mind right. And as always, let's get to work. Well, finally, after 8 weeks of coming on here and saying that the market has dropped, I finally get to report that the market had an up week. So we broke the 8-week streak. And so now going into the holiday weekend, Memorial Day this weekend, the market will be closed Monday. Investors can feel a little bit better about where they stand with the market coming up a bit. So hopefully you've made some good investment decisions, started to invest, and have profited on some of the gains that we're seeing this past week. So, last week, Walmart and Target reported earnings. They were not good. Everybody, that really spooked the market. We had the sell-off continued this week. Dollar Tree, Dollar General reported strong earnings, strong guidance. That was also followed by Costco. And so you see that really kind of help the market a little bit with those companies reporting strong earnings and not everybody being spooked about the consumer and that the sky has fallen. So, like we say a lot, most of the best days happen within 2 weeks of the worst days. And so that again has rang true here. So, hopefully this has helped you with your mindset as far as the market is concerned. There's a lot of research that shows that the more education you have, especially when it comes to investing, the better off you're going to be, mainly because you're able to kind of subdue that emotional brain that's always telling you to make a move, right? So it allows you to be able to think more intellectually about, okay, where are things going to be in the future versus where are they going to be next week. So hopefully we've been able to help you out with that. And today I thought it'd be fun to look at, a past investment by somebody, Warren Buffett, and his investment into American Express in 1963. And I know I cover Warren Buffett a lot, and there's a lot of other investment people that I could follow and others that I read. And one of the things that I would tell you is that when it comes to investing or looking at investors that maybe you want to model your investment strategy on, it's important to pick somebody that kind of has the same personality as you. So I think that's why I'm drawn to Warren so much, is because I just feel like, I obviously don't know him personally, but his investment style, his way of life, all of those things, seems to gel with my personality. And so I think that's why I'm drawn to him more than some of the other investors. Now, I do a lot of research on other investors, finding out what their strategies are, what kind of the thought process is behind the investments that they make. But over the years, I feel like it's just an easy pathway with Warren Buffett, because I feel like our personalities probably are a little bit the same. And so it just makes it a little bit easier. I can tell you that, when it comes to investment strategies, and I have students ask me this all the time, how do you pick one? Well, it's important to learn like different ways of making money, right? I mean, there's all kinds of ways. I mean, there's people who do a lot of derivatives, options trading, short selling, things of that nature. And it's all fine, and it's all fine. I mean, as long as you are consistent with your strategy. I think one of the big problems that some investors have is that they do a strategy for a little bit, it doesn't work, and then they switch, and they're constantly switching strategies, so they never really learn a ton about themselves or the way that they're trying to invest. And so for me, being able to do something consistently and investing in good companies and letting them do the heavy lifting for you is something that just kind of goes with my style. So if you're listening to this probably is a kind of an extension of that, and you're probably thinking the same. So I short companies every once in a while. I don't do it very often, and the reason is I'm just an optimist. Like, I always think things are going to get better. And so it's hard for me to just sit there and short a company all the time, expecting the worst for a company and its employees and customers and the like. It's just not really kind of who I am. And so that's why I like to put myself with companies that I think are going to, invest in companies that I think are going to do well for the foreseeable future. So when you look at, different Warren Buffett investments, one that always comes up is American Express, and he's owned it for, 58, 59 years. And so I kind of want to let that be the first thing that sinks in. If you look at you can Google a chart of Warren Buffett's wealth, and you'll notice that most of his wealth has come past the age of 65. And so I know that many of us listening to this are much younger than that. And so I think that should be a little bit of a lesson in and of itself, is that when he makes an investment, he truly doesn't touch it for a very, very long time, if ever. Right? So unless he's buying more shares, but he's not trading in, trading out of it. And so when you look at that, when you look at him owning American Express or being an investor in American Express for 58, 59 years, that is an accomplishment of its own. Most of us would not be able to own a company that long without touching it. And so that is, an extremely important piece of this, is that if you find a company that does well, that is doing well, and the story doesn't change, you shouldn't change just because you think somebody might do a little bit better. And so, again, there's a lesson to be learned just in that, but most of us, we get itchy looking for the next best deal, and sometimes you own something that's doing pretty well on its own. So you have to think about how many dividends that he's collected over the years off that investment, how many dividend raises American Express has made. And so I thought it'd be interesting just to kind of go back and look at American Express in 1963 and just kind of maybe figure out, or look at how the company was structured and maybe what drew him to that kind of business back then. So a couple things to just point out is that American Express was a much different business back in 1963 than it was today, right? So when you think about American Express today, you're thinking about the credit card company and all the users of that. But the credit card for American Express didn't really come out until 1958. And in 1963, that segment of their business had only been profitable for 2 years. And so the real driver of American Express's business back then were traveler's checks. And I know that many of us listening to this today don't know what a traveler's check was, but that was a way for you to be able to travel without having to take a lot of cash with you, because there was a danger with that, right? So people would buy traveler's checks from American Express. They would be accepted all over the world. The American Express brand was very powerful in that. They knew that if somebody brought an American Express traveler's check, that it was good for the money, the amount that was on there. And so back then it was one of the number one, it was the number one segment of their business, but it also is what helped establish their brand as a trustworthy, safe investment for not only consumers, but for merchants that were accepting these traveler's checks around the world. And so that was their number one way that they made money. They also did money orders. People paid their utility bills through them. And they were just starting to get that credit card business off the ground. And you have to remember, it's 1963. There's no internet. There's no network. I mean, when somebody was using a credit card, it wasn't like they swiped it and it went through the network. They had these things called knuckle busters where they would make these imprints. You see the old movies and they're moving their hands and making that imprint on those credit cards that they would later use. And so that piece of the business was just starting for them. But when you look at that and you look at, in the 50s, they had the number one credit card was the Diners Club or whatever it was named. But from an investment standpoint, if you look at the credit card and you look at that early growth of people knowing that the more hands that they got their credit card into, the more money they were going to make in the future, right? And so the difference between like American Express than Visa and MasterCard is that with American Express, you pay a fee to have their credit card. And so that fee that consumers pay to be able to use the American Express card that they still pay today is that it gives American Express a great base in order for them to have that cash flow coming in, right? So they know that if they have so many cards outstanding that that all those consumers are going to pay them a fee, and it gives them a nice base of revenue to be able to do other things. But back then, it was traveler's checks and money orders. And so that was a massive piece of their business. And they're really, if you wanted to travel, that was really your only way of doing it besides, carrying a ton of cash with you. You could do a letter of credit from your bank that you could carry around, but that was pretty cumbersome. And so not a lot of people did that. So, looking at that, you look at what their earnings per share were. Back then, they grew from $1.05 to $2.52. Going from 1954 to 1963. So that's a nice growth rate of 10% every single year. And their book value grew from 42 million to 79 million. So throughout that decade of the 50s, early 60s, American Express is seeing this nice growth, not super fast growth like we think of today with technology companies that are growing at 30%, but still steady as she goes growth throughout the decade of the 50s. So the numbers are checking out. The growth looks good. It looks like it can continue to grow. So that long runway that we like to see, that they're going to be able to add business for the foreseeable future. And all of that looks good. Assets look good. Liabilities look in check. And then all of a sudden, scandal hits American Express. And this scandal is referred to as the salad oil scandal. And so at the time, it was one of the biggest corporate scandals that had happened. But there was a subsidiary of American Express, and it was called Allied Crude Vegetable Oil Refining, which was basically kind of supposed to be a salad dressing company. And they had an inspector that went in there, looked at the barrels. They had water 3/4 of the way up the barrel, and then the rest of it was salad oil. And so soon after that, everybody was worried that American Express was going to have to file for bankruptcy because of this. And so, you go through there, Wall Street, feared that they had assets of about 175 million just in salad oil that were all basically was going to be worth a lot less. They had basically used that salad oil as collateral, basically borrowed against it, fancy word for borrowing against it, taking out a bunch of loans that they defaulted on, and they filed for bankruptcy. So because of this, investors were worried that this was going to drag American Express down with them, right? So the stock price got cut in half because of this, because investors were very afraid that this was going to impact them so negatively. And you have to remember too, it wasn't like today. There wasn't an internet. There wasn't, people reporting on this all the time. I mean, you're talking about only being able to get information through annual reports and trying to figure this out. And so basically Warren Buffett did the old school thing. He went through and he started doing homework, studying the company. He actually went around to ask local merchants and vendors whether their spending habits were going to change because of this. He talked to banks. He talked to travel agencies. How is this going to impact their usage habits? And then he basically determined that he thought that American Express would be able to continue, and basically work themselves out of the damage that they were going to take on by this scandal. And so he looked at what he thought the loss could be based on the scandal. Based on his numbers, thought it was really only about half of what the company was worth, and decided, okay, I'm going to step in and make an investment into this company. And he ended up buying 5% of the company for $13 million back in 1963. And so, he believed in his method, his homework, and he basically put it out there, was willing to lose a lot of money. Now, I know that $13 million, it's a lot of money today, but back then it was a lot of money to Warren Buffett. That $13 million investment for Warren Buffett, that represented 40% of his partnership's assets. 40%. So, if you're wrong on this, that's really hard to come back from. That is extremely hard to come back from, right? If you're putting 40% of your money into something and it doesn't work out. And so, and at the time, I think this is also interesting, is that the PE ratio, price to earnings ratio for American Express at the time was 15-16. And this is kind of the first time that Warren decides to invest in a company that's a great company at a fair price and not something that's trading at really low multiples. And by really low multiples, I mean a PE ratio of less than 10, maybe even less than 5 if you look at some of his earlier investments. This one, 15-16, was not something that was considered cheap back then by any means. And so for that reason, I find it, it's kind of would probably be considered the first major investment he did in a company that was a great company at a fair price. And so you look, I'm looking here, you look at Google, for example. I've mentioned this already, but, I've been following this stock for 15 years and I've never seen the PE ratio under 30, as I said, I think in last week's episode, and today it's at 20. So, every once in a while you get the opportunity to purchase a very, very good company at a fair price, and you have to, take the chance to do that. So, but again, you look back at this and you look at that decision he made. If he would have been wrong on this, everything would have been different. We might not even know his name. And so it's just interesting to go back and look at that. So what are some of the things that we can take away from that investment? Well, knowing how a company makes money, something we've discussed numerous times, makes a huge difference in your trajectory as an investment, on your investment journey, just knowing how a company makes money. But American Express, has a fantastic business model. You have, your consumers paying a fee to have the right to use your product, which gives American Express a lot of flexibility. And so, looking at one of the things, I think I pointed this out on an earlier podcast, but reading American Express's annual report this year, I found it very interesting that 40% of the new card issuers or new card issues that they made were to millennials. And to me, that shows, okay, the brand is still very strong. They're getting that card in younger and younger hands, and they're going to use that card for the foreseeable future. And I like companies that are doing that. So, who are some other companies that do that where you have to pay to be a consumer of theirs? Well, another one of those would be like Costco, right? And if you look at Costco and you look at they're probably the best retailer on the planet right now as far as, you're paying a fee to be able to shop there. Since you're paying that fee, it entices you if you're going to shop, to go back there. I mean, why would you go to Target if you're paying, a fee to shop at Costco? You're probably not going to do it. And so it makes your consumers loyal because they're paying you something. Same thing with Amazon Prime, right? You're paying a fee to them. You know that they're going to increase that fee every once in a while, but as long as you feel like you're getting the value for that, and that's the key, is the company has to provide you a value for you to keep renewing. And so consumers of American Express feel like they get the value for that. They do luxury lounges in airports around the world. If you ever have any kind of issue with somebody charging you wrong or somebody using your card, or somebody using your card without your authorization, they put the money back in your account. They don't ask you any questions, and so they're easy to do business with. I mean, there's all these things that provide value that are the reasons that consumers are coming back to these businesses over and over and over again. And so that cannot be understated when you're looking at companies that you want to invest in. So, when you're looking at these companies, you're looking at companies that you want to potentially invest in for a long period of time. Think about that brand loyalty that the consumer is going to give them. Because this isn't like you go to an interview and people always say, I love change. Oh yeah, no worries. I like change. Yeah, I roll with it. Whatever's going on, I like change. I love change. The fact of the matter is most people don't. Right? We get into our habits, and those habits are sticky. And companies know this. Right? They know that our habits are sticky. So as an investor, use that to your advantage. Right? People that drink Coca-Cola, people that go to McDonald's, people who use American Express cards, right? If we had I don't know how much money, if we had a ton of money and we wanted to come up with a credit card to compete against American Express, it would be very, very difficult, right? I mean, there's some businesses that are very difficult to compete against, and you want to invest in those businesses, right? It's the same thing with what Apple has done with the iPhone, right? If you've used an iPhone since you were 15 years old and you've used it for 10 years, the likelihood that you're going to switch is minimum. It's minimum, because as you get old, you don't want to learn a new phone. You don't want to learn how to do this. I can't even tell you how many people I've known that have switched phones, whether which one way or the other. They use it for 2 weeks. They take it back. They get their old phone because they don't want to have to learn, right? People are creatures of habit. So if you can invest in companies at a fair price that people are going to use for year after year after year, man, that is the sweet spot of investing in really good companies. Because if you're investing in companies that are constantly having to compete, that don't really have that moat around them of how they're able to be one step ahead of the competition, it becomes very, very difficult. So hopefully this is a lesson that you can use, because it's a good lesson. And then if you find something that works well, you invest in a company that's good, stay with it. And I think that is probably one of the more difficult pieces of this. Again, I said it early on, but just sticking with companies that are doing well and not always seeing that grass is, greener on the other side and this company's going to be doing this, and, stick with the ones that are doing well and let them do the hard work for you. So hopefully this allows you to kind of just take a step back and reflect on the companies that you've invested in or the companies that you want to invest in. Because when you look at investing in a company for a decades long, there's always going to be something shiny and new. And I'll give you an example here, like a couple of businesses that I really enjoy using are Uber and Lyft. But they're hard companies for me to invest in because there's so many moving parts, and I see the competition between them, and there's just so many moving pieces, and the drivers, and how are you going to pay the drivers, and who's liable for this and who's liable for that. And, trying to learn that business and seeing if it's something that I want to invest in. And then when I compare that to Apple or, a company like Apple, I just end up wanting to put more money with Apple because it's easier for me to understand how they're going to make money. And so, you know, you only have so much money. You only have so much money that you can invest. And so your best idea is, you know, your number one idea is going to be better than if you're just looking for stock number 21 that you want to invest in. And so, but the hard part on this for me is that back then, you know, Warren didn't know how this was going to turn out, and putting 40% of your net worth and all the investors that you have, to have that kind of confidence to put 40%, that's next level, right? I mean, that is really putting your money where your mouth is and your entire business and your future into that. I mean, you got to know you're right on that, which that is the part that separates him from everybody else. And so that's why he is who he is, because man, that takes a lot of guts to be able to do something like that. So I hope this helps you out. I hope that this helps you with your mindset when it comes to looking at how you view and analyze businesses that you want to invest in. And, you know, this is the kind of homework that you need to do before you're making an investment. So I haven't said it in a couple of weeks because I just forget, but I am not your financial advisor. This is for entertainment purposes only. Past performance is not indicative of future results. So please consult your financial advisor before making any investment decisions. So that's all I got for this week. Thanks again for your time, and I'll see you next time. Thanks for listening, everybody. Have a great week.